Hi, this is Wayne Wagner with Vizionary Wealth Management. Today I want to talk about long-term care and long-term care insurance. So long-term care is care that is usually toward the end of life, but it's that care that's needed when we can't do things for ourselves. Typically, long-term care insurance kicks in when we can't do at least 2 of the 5 major duties of life or care duties for life. So we can't dress ourselves, we can't feed ourselves, we can't bathe ourselves. When we start to fail to be able to take care of ourselves, it's at that stage of life that we're talking about. Now, statistically, if I have 2 healthy adults at age 40, 1 in 4 of those people is going to require long-term care at some point in their lives. The numbers go up from there, so if you're at retirement age between 60 and 65 years old, those statistics are now getting closer to 1 in 2 of you are going to, or should I say of us, are going to need some form of long-term care at one point or another during our lifetime. Now, when we think about how to cover that cost, or if we even need to cover that cost, the question for most of our clients is not really, will we need to cover that cost for one of you? It's really a question of, can we cover the cost for one of you and then still have enough money to care for the survivor? And so that's where long-term care insurance comes in, is to try to offload some of that risk. Now, if your net worth is above $10 million, very often the conversation is, hey, this is a risk that we can bear ourselves. In fact, the threshold may even be a little bit lower than that, but really not much lower than that. So for most of our clients whose net worths at retirement run up to about $7 or $8 million, we're typically looking to offload some of this risk onto an insurance company. Now, for a very long time, since about the 1980s, long-term care insurance companies issued policies, and they continue to issue policies today, where you take on an annual expense, kind of like you would with your car insurance or your homeowner's insurance or some other form of liability coverage, and you pay a premium each year. The problem that we've seen is that this was a relatively new kind of insurance in the 1980s, and the insurance companies didn't have a whole lot of experience. Well, 40 years later, they've got a lot more experience, and they have figured out that they didn't price these products very well. So they were issuing these policies to people in their 30s, 40s, 50s, and 60s, and those people are now 30 to 40 years older, and wow, the insurance companies are getting crushed. Their cost for providing this care is way more than the premiums they charged on the way in. And so what's happening is 2 things. Where they can, they're going back and they're raising premiums on existing policyholders. And secondly, they are substantially raising the premiums on new policies that they're issued, and they're taking that language that may have guaranteed that premium to be level for life. They're taking that kind of language out of the policies. So now we're getting policies that are more expensive, often provide less coverage, and no protection that the insurance company won't raise the premiums down the road if they get in a hole and they haven't properly underwritten these policies. So those are some of the problems that we're seeing. Statistically, a lot of us are going to need this kind of coverage. Statistically, not a high percentage of us can afford to just stroke a check for what may be $100,000, $150,000, $200,000 a year from our net worth and expect to have enough money left over to leave the survivor solvent if that long-term stay carries on for 2, 4, 6 years. If we're writing a check for somewhere between $100,000 and $200,000 a year for 4 to 6 years, it's going to put a big dent in most people's net worth. So what we look at today is typically offloading this risk through some form of a hybrid insurance product. This may have It'd be an annuity that has a long-term care rider on it. It may be a life insurance policy with a long-term care rider on it, or some hybrid of all three of these kinds: annuity, life insurance, and long-term care. So what we're typically looking to do is to basically tie up a portion of the net worth in an investment vehicle that's going to do two things. Number one, if there's a long-term care need, that insurance policy is going to pay off and help us offset some or all of the cost of the long-term care stay. And or if we don't have a need for the long-term care during your lifetime, then upon death, there's a death benefit that comes back into the estate. Now that really helps us when we do that on each spouse, because that way, if we don't need it on the first death, that money comes back into the estate on that first death to help the surviving spouse remain more solvent financially after that first death. And then upon the second death, the same thing would happen. There would be another insurance payment back into the estate to go to the heirs, often our kids or organizations that we care deeply about. So this is some of the changes that we've seen over the course of the last 10 to 15 years in how we approach long-term care and long-term care insurance in planning for our clients. If you have any questions, as always, please feel free to reach out to us. We're always here with perspective for the decisions ahead. Take care.